Welcome to today's class. Today we are going to look at analysis and interpretation of financial statements. Now, when we talk about analysis, we actually know that it has to do with creating a relationship between two values, whereby the analyst can infer meaning from the relationship that has been created. Ordinarily, we know that the financial statement doesn't make sense. Looking at it, if you aren't an accountant or a finance expert, you wouldn't know what the financial statement talks about. Hence, the essence of the analysis and its interpretation. Although the analysis and interpretation deals with the historical data that has been provided by the accountant, but all the same, it is important that the analyst take a look at this and create some relationship so that he can be able to predict the future using the historical data. Now, we are going to be looking at this and using ratios. Ratios can be used for comparison. In making this comparison, we can be able to compare over a number of years. For example, before the removal of 5 years financial summary, we can do analysis for 5 years and make a comparison of what they are. And this can help us to determine if the company is growing or not. We can also make comparison with related firms. We can look at companies that are in our industry and compare our affairs with theirs. This will tell us if we are performing well or not. And we can also make comparison with industry average. For examination purposes, you will often be given industry average where you have to compare the company's ratio against the industry average. This will enable you determine if the company is a well-performing company or not. Are you there? Categories of financial ratios. We have majorly five categories, and these categories are financial performance, efficiency ratio, liquidity, debt ratio, investor ratio. Now, users of financial statements, we know that there are different users of financial ratios or financial statements, and these users often have different information use or needs of the financial statement. We have the management, the lenders, we have investors, employees, suppliers, customers, government, and general public, which include you and I. So we're now going to look at the categories of financial statement. Now, in looking at profitability ratio, the first thing is return on capital employed. Return on capital employed is the most important profitability ratio. The formula is simply profit before interest and tax all over capital employed. And capital employed can be computed using two methods, but I identify only one method here, which is share capital reserve plus preference share plus debt capital. This gives us capital employed. So it is the most important role profitability computation. So where you are required to make computation for profitability of the entity, you must analyze and calculate rules, which is return on capital employed. We now have return on shareholders fund. This measures the return that the equity holders are expecting, and the formula is profit after tax all over share capital plus retained earnings and plus OCI. You know the meaning of OCI, other comprehensive income. We now have return on assets. This measures how much each asset is getting as a return for it being used in generating profits for the company. And the formula is profit before interest and tax all over assets. However, there are different variations of assets definition, Assets can be defined as total assets or net assets. As an analyst, you are at liberty to use any of these, but you must defend and give reasons why the one you've chosen is more appropriate in your analysis. We now have factors that can affect returns. Now, what are the factors that can affect profitability ratio measurement? The first one is turnover, which is the revenue of the company. Where a company has a high revenue, definitely it will have a higher return. Another one is cost. Where a company has a higher cost of sales, which is more of an indirect cost, the company will definitely have a lower returns. So when a company manages its costs, it invariably increases its revenue and profit or return. Then other expenses which are there, you can see them: profit before tax and value of assets also. This affects the returns of an entity. So while making your interpretation of the analysis which you've done, you must be able to interpret the relationship and what could have led to increase in return or decrease in return, looking at the financial statements given to you. But just note that these are what we are going to be doing till we conclude on this topic: analysis and interpretation. And it is important that you know that this is often said set every diet. So 20 marks. So if you master this topic, remember you just got your 20 marks free and you have the remaining marks to battle with in order to pass. So we have profit sales ratio and cost sales ratio. Now the profit sales ratio tells us how much of the sales we made we earn as profit. It tells us in percentage that out of the 100% of the sales, so percentage is earned as profit, and so percentage is also earned as cost. So we have gross profit. Now profit has different definition. We have profit can be defined as gross profit. Profit can also be defined as profit before interest and tax. Profit can also be defined as profit after tax. It depends on the variations you want to use, but whichever you decide to use, you just have to be consistent and also back it up with more cogent reasons why you've chosen to define it. But to provide a guidance, it is more appropriate that you adopt profit before interest and taxes as your definition of profit when making your profit sales ratios analysis. Then after that, we have asset turnover ratio. Now, this asset turnover ratio is simply revenue divided by capital employed. Revenue divided by capital employed. So now this tells us how much sales is generated by each 1 naira of our assets. Are you there? So a higher asset turnover ratio indicates that the management of the company have efficiently utilized the assets to generate enough revenue. Percentage of annual growth in sales. This is actually trend analysis and is often used in case study when you get a professional. But that is that for that. So the formula is simply to calculate our percentage change in sales, which is current sales minus previous sales divided by previous sales times 100. Then we have efficiency, which is working capital ratio. Efficiency calculations help us to determine how efficient management is in the management of the working capital of the company. Now, where the cash operating cycle is high, we say that the company is over trading. Where it is low, we say the company is under trading. Although there is no perfect benchmark upon which we can determine that this is high or low, because the standard never gave any. But however, industrial average would always provide a guide towards determination of overinvestment or underinvestment in the working capital of the company. Then one would ask, what is cash operating cycle? This is the cycle of transactions from the point of credit purchases to the point where those credit purchases are paid off. That is, credit purchases, inventory, sales of those inventories at credit, collection of the credit sales, and the payment of the credit purchases. That is what we call cash operating cycle. So it is easier to explain. It's often represented with a diagram, and this diagram is often in a cycle form, with each arrow explaining where the transaction started from and where it ended. But that is that for that. Now, in measurement of efficiency ratio, we often look at average time to collect from trade receivables, which you can see in 3.2. The formula is trade receivable all over credit sales times 365 days. We also look at average time for holding inventory. This is also measured as inventory all over cost of sales. Average time to pay suppliers. This is also measured as trade payables all over purchases. Then we have cash operating cycle. Cash operating cycle is easy to calculate. I've already explained what cash operating cycle is. However, the format is this: average time to hold inventory plus average time to collect receivables minus, you now add them together, it gives you this, then minus average time to pay payables. That will now give you cash operating cycle. So that is a formula for calculating our cash operating cycle, as the case may be. So with this, we progress further. To liquidity ratio. Liquidity measures the ability of a company to retire their obligations as they fall due. We have measurements of liquidity. The first one is current ratio. We are already used to this, I know. Current ratio, and the formula for current ratio is current assets divided by current liability is to 1. Hope you can see that. Good. And the ideal current ratio is 2:1. So we'll now move on to quick ratio. Quick ratio measures the current asset excluding inventory, which is the most illiquid assets and current assets. And the formula is current assets less inventory divided by current liability is to 1. And as I said earlier on, the most ideal quick ratio is 1:1. Quick ratio is also called acid test. Some authors prefer to call it acid test. So we'll move down to cash ratio. Cash ratio is not too popular, but however, it is important that we draw your attention towards this. It measures how far can our cash and cash equivalent retire our falling obligations before we can attempt to sell other components of the current assets. So the formula is current cash and cash equivalents divided by current liability is to 1. So we now have gearing or leverage debt ratio, which is, we'll be measuring gearing ratio. Gearing has two methods of computation, and the first method is debt ratio, which is debt over equity times 100, or debt over capital employed. What is capital employed? Capital employed, I've told you ab initio, is equity plus debt capital. That will give you capital employed. So whichever variation of these two methods you choose to use to compute gearing or leverage ratio, it is cool for us in the accounting profession. Then we'll move down to interest cover ratio. Then looking at interest cover ratio, it is important that we look at it this way. Interest cover ratio also try to measure the ability of the company to pay the interest attached to the debt capital, and the formula is profit, and the formula is profit before tax all over interest. Profit before tax all over interest, and it is measured in times. So now move to investor ratio. Looking at investor ratio, we'll be looking at earnings per share. Earnings per share has been treated under IAS 33 by my colleague. Now, when we talk about earning per share, this measures how much each share of the company is earning from the profits. You understand? And the formula is profit attributable to the ordinary shareholders divided by weighted average number of shares in issue. It is usually stated in kobo. So now price earning ratio. Price earning ratio is one of the most important measure of investors ratio. It measures the level of confidence investors have in the company. If the investors have higher level of confidence, they will pay higher amounts to acquire the shares. If they have a lower level of confidence, they will pay lower amounts to acquire the shares. In fact, it is said that if a price earning ratio is 10, it implies that the investors are prepared to pay a price equal to 10 years of earnings of the shares. But that is by the way. The formula for calculating our price earning ratio is market price per share divided by earnings per share. We now have dividend yield. Dividend yield is simple to calculate. It talks about how much the dividend is yielding. You understand, as a percentage of market price per share. It is actually calculated by saying dividend per share divided by market price per share. Now that is that for that about investors ratio. We now look at limitations of interpretation technique. One is difference in accounting policy. Difference in accounting policy. Another one is the companies may operate in different segments of the market. There are different segments of the market. For example, if we take the airline markets, we have different segments, and these segments are based on geographical locations. Now, those airline companies operating in the eastern part of the world are said to be operating in Middle East segments of the market, while those ones in the western world are said to be operating in the western parts of the world, which include UK, United States of America, Germany, Spain, and all that. Why those in the sub-Saharan African are those said to be operating in Nigeria, Ghana, Togo, Lome, and what have you, and Cote d'Ivoire, and all that. Now, this market is segmented. Now, let's come home. When we talk about the soap industry have different segments. We have the detergent segment, we have the liquid soap segment, we have the liquid soap. Even in the liquid soap segment, we have those ones that are actually produced for bathing, those ones that are produced for washing of plates, those ones that are produced for washing of cars, those ones that are produced for even washing of clothes also. So you see, the market is segmentalized in a way that we cannot conveniently compare different companies that are operating in different segments. Now we have uses historical information. Now, this information are of past and cannot be of help to us to predict the future. The past is past, and we are often more concerned about what the future holds and all that. So these are the limitations of analysis and interpretation of financial statements. Now we take a question to buttress our point. Practice question 1. They said A, the basic financial ratio can be grouped into the following broad categories. 1. Profit, ability and efficiency. 2. Long-term solvency and stability. 3. Short-term solvency and liquidity. 4. Shareholders' investment ratios required. Briefly explain the main aims and give 2 examples of each of these categories. 8 marks. So we go to the solution: profitability and efficiency. The aim of profitability is to determine the performance of the entity, and the efficiency determines how best the management has utilized the resources to generate returns for the shareholders. Examples of profitability and efficiency ratios are return on capital employed, average time to collect receivables. You done. We move to B, long-term solvency and stability. The main aim of long-term solvency and stability is to determine the gearing level of a company. This tells analysts how the gates of the entity, if the fate, of sorry for that breaking. The fates of the entity if the debt holders pull out their investments. Example, gearing ratio, interest cover. Now, short-term solvency and liquidity. This measures the liquidity of the entity and its ability to retire its falling obligations. Examples, current ratio, quick ratio. Shareholders' investment ratio. This measures the return of the ordinary shareholders. Examples are earnings per share, price earning ratio. So these are just what we were expected to do, and that is that for that. So we'll move down to the next question, which is B, the B part. They said the following is the financial information extracted from the records of Nwokeke Nigerian PLC for the year ended 31st March 2017. So we have inventories, raw materials, work in progress, finished goods, purchases, revenue, cost of goods sold, trade receivables, trade payables. Additional information. The directors of Nwokeke Nigerian PLC are of the opinion that the average cash operating cycles of companies that operate in the same industry as Nwoke PLC is 75 days. You are required to explain the term cash operating cycle. Then we'll go back and look at the explanation I put forward. Cash operating cycle. I said this measures the cycle of transaction from point of credit purchases, inventory holding, credit sales, collection of cash from trade receivables, and payment of cash to trade payables. Full stop. This cycle is measured in days, weeks, and or months, as the case may be. You see, just few lines to get to 2 marks. Are you there? So we'll now look at II part of the question. Calculate the cash operating cycle of Nwokeke Nigerian PLC. This calculation deals with formulas, and I have explained these formulas at the beginning of the class, but it will be reproduced here for your perfect understanding. So we have the calculation. This is it. Let me bold it for your perfect view. So raw material is raw material divided by cost of sales times 365 days. You now go to the question. The value of raw material is 142,500 divided by 712,500 times 365 days. That will give you 73 days. Then for work in progress, the value of work in progress divided by cost of goods sold times 365 will give you 29 days. You see, for finished goods, same will give you 97 days. Then we'll now look at trade receivables. Trade receivable formula is trade receivables divided by sales times 365 days. So this is a value of trade receivables, this is a value of sales, and this is our days. So we have the answer 93 days. Then you add all this together, we have this 292 days. Then we now less trade payables. You would always deduct trade payables. So, and the formula is trade payables over purchases times 365 days. And this is a value of trade payables, and this is a value of what? The value of purchases. We now have 88 days. Take this away, we have 204 days. You can see that the cash operating cycle is 204 days. And remember, we were given an industrial average to be 75 days. Then we are done with this. So we'll go to III and look at what it told us to do. Assess the performance of NWOKK Nigerian PLC cash management relative to the industry average performance. So we'll now do that. How do we do that? We'll come down here and assess it. The management of working capital by NWOKK is poor compared with industry average of 75 days. The company has a cash operating cycle of 204 days, which is way higher than the industry average, and it shows that the company is over trading in its working capital, and something needs to be done urgently to ensure that this over investment in working capital doesn't lead to liquidity problem in the future. So this is the assessment, and the last one says the two cognate steps to be taken by NWOKK PLC are intensify their marketing. 2, the credit policy need to be reviewed downwards. So you look at this in the notes, and you can still go through the class, oftentimes as many as you want. And if you have a question, do drop the question with us. We shall continue with analysis and interpretation with another question in our next class. Do have a nice night. Thank you.